When the biggest hedge fund in the world makes a massive bet, you should pay attention. Watch their position and keep an eye on the market, geopolitical events, and the potential for excessive turmoil. This will be interesting. You came here for the truth, so let me unveil that for you. Today we're going to look at a $22 billion bet that Europe will collapse. Let's begin with hedge fund Bridgewater makes a $22 billion bet against European firms. So they are suggesting that particular companies are going to be in big trouble. I'm going one step further and suggesting that if these companies do fall, that Europe is going to start to fall. So, top global hedge fund, Bridgewater. I'll talk about them more in a moment. Short positions in Germany, France hitting $12 billion worth. Now, you have to remember the ripple effect. So if they own debt of Greece, if they own debt of the weaker nations, they are ultimately the ones that are on the hook for it. Will the central bank be there to bail them out? We'll see. Bridgewater has shown its hand in Europe with a $22 billion bet against some of the continent's biggest companies. Filings reviewed by Reuters show it's basically something that they've been continuously adding to over these past few weeks. And I've been showing you this, but now this is the absolute biggest this position has become, and it is growing fast. Bridgewater short targets, you can see here for yourself. I mean, you're looking at all of the biggest companies in Europe, Unilever, Total, Siemens, and so many others. I mean, it just goes all around Europe. You can see that for yourself. Look at these names, all of them. Now, this is going on simultaneously when the ECB is holding on to a lot of corporate debt. But it is the claim of the ECB that they will begin to taper off on their purchases. Perhaps that's exactly what Bridgewater is hoping that they do. And it will be very, very good for Bridgewater should this actually happen, because obviously the stocks are going to chase this pattern. The question I have is, how can they allow this to happen? How can the ECB allow the shares to simply be devalued over time when this has been their mandate to push them up higher or to keep them alive? I believe that we will have central bank intervention, the likes of which we have never seen. But before that happens, we are going to see a massive deflation. So we're going to have a real deflation followed by a massive inflation. But we have to have that deflationary period first. Yes, there's deflation, but it's more of a slow and steady process that's been happening. I don't think that that's what we're waiting for. I think we're waiting for that big, off the cliff type scenario, and the central banks have to react very quickly. All right. So, Ray Dalio, he made $50 billion for his clients, topping the list of the biggest hedge fund moneymakers ever. So that's huge. You could see that. And now they're making this bet that Europe is about to fall. I think it is very important. We need to listen very closely to what is going on with Dalio, Bridgewater, and all of these hedge funds, all of these investment companies. And when they make decisions, we don't necessarily need to follow what they do, but we need to just pay attention. That's all I'm saying. Okay? Look at this here, changing gears. The 10-year US yield, you can see it for yourself here, heading into this territory, very, very critical, because at this time, we have seen this before, no doubt, that previously what had occurred. I don't know if we're going to see that again just because it's in that same territory, but it is of note. 30-year mortgage rate, take a look at this. Heading back to a level, and this is very surprising to me, heading back to a level that has not been in years. I mean, we're looking back to 2014 levels at this time. So overall, there has been a decline since, let's say, 1980. But we're talking about almost 4.4%. That is quite significant compared to where it was a few years ago. So they brought the rates down considerably. But in other areas of the world, I mean, you can get a mortgage for basically nothing. But in the US at least, you can see that the mortgage rates have been coming up over the past even couple months. It's been quite dramatic, actually. Now, I found this to be interesting. I thought there would be a little different scenario, but this is all within 2018, all right? There's been a decoupling that you can see right here between mortgage rates and the mortgage apps. Now, the apps, if somebody's going to apply for a mortgage and they know or they anticipate interest rates are going to rise, I would think that they would try to get into the market now. That's my thought. But apparently, at least in the short term here, that is quite the opposite. Applications are in fact heading downward. We'll see what happens. I want to see the longer trend on this one. And of course, I will definitely be keeping you up to date. This here, it might be hard to read. The font is quite small. It's blurry. So I'll just quickly cover it. We are nearing the longest 60-40 bull market without a 10% total return drawdown. 60-40 bull bear market. Now what happened here? Look at this instance where we had this 8.7 years, right? We essentially had come to the same territory of the Roaring 20s. And that's something to really say how far that this market came from, basically 2009, March 2009, all the way into earlier this year. The market had really, really performed well. I mean, there's no way to deny that. Yes, it was all because of central bankers. That's a fact. But I'm just talking about looking at the equity prices themselves. They had gone crazy through the roof, and those who had bought on March 2009 and will sell at the absolute right moment will be doing very, very well for themselves. That's for sure. I hope you just have that perfect timing. You're going to sell right at the very top. Of course. All right. Now, the Fed funds rate, you can see it here since 1980. Clearly, it's been declining over the years. Look at this, though. The federal debt. I love to compare the two of these. Total public debt as a percentage of the GDP. Now, very clear. Time goes on. Debt expands. Deficits get worse. But think about this for a moment here. If interest rates are rising, probably won't get very far. What's going to happen to the debt? We're all the way at the bottom. I believe that the debt is going to have to skyrocket. There's no other way to look at this. Debt will have to skyrocket. All forms of debt. All right, this individual here is talking about, basically posted this chart here. Total non-mortgage debt, $2.7 trillion at the peak in 2008, and we are now at $3.8 trillion. That's a 41% increase. The big drivers: auto loans, student loans, credit card balances back at their 2008 peak. Look at that. We are talking about every sense of the word an expansion in the amount of debt. How much further can it go before it breaks the back of everybody? I don't know about you, but there are constantly recommendations. Get a line of credit, get an expansion of your credit on your credit card. They're calling you. Well, do you want to take a home equity line of credit? Do you want a second mortgage? No, thank you. I'm paid down on my debt. I don't carry a balance on my credit card. I don't want any of this stuff. I don't want any of your programs. I don't want anything. Don't offer it to me. I decline. I am not interested. They keep hounding me, and you have to continuously say no. No, thank you. I don't want it. I don't want to be in the situation that people have found themselves in. It's a trap. Debt is a trap. Now, guess what? Guess who set up the debt-based system? That's right. It's the central bankers. It's the bankers, the technocratic elite. They made this system to keep you in this trap. And they're doing it so intelligently. People are unfortunately truly stuck. They're not going to be able to get out of the rat race. All right, now switching gears one last time, I just wanted to show you something. Chicago is undergoing, the amount of, let's call it, to stay good for the, those who are watching me right now, the situation here, what's happening, it's truly, truly very bad. Over the years, we are going to see this escalation take place. Look at what happened throughout the years. It's been increasing and increasing and increasing, and 2018 probably going to go even further. We are not even basically halfway through February at this time, and already it's looking to beat its previous high. We'll see what happens. It's unfortunate. This is not one statistic that you want to see. Those in Chicago personally have told me many areas of the city are just off limits. Illinois is just, many places are not doing very well. And a lot of people are leaving. That's a fact. I've done a video of mine that has done very well. It has hundreds of thousands of views, and there are so many comments that are coming in every single day talking about people leaving Illinois or wanting to leave Illinois. They're talking about Chicago, and they are really reaffirming the data that I found here. So I do really appreciate all of the people that input their facts and their data on top of the statistics that I bring to you. So I really do appreciate each and every one of you. That's all for this video. If you found it informative, then I would appreciate a thumbs up. Last but not least, if you found the video informative, I know you'll find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can flip through these books at Amazon. Links are in the description below. Take care.